welcome to the Dream Team, Mr. Studwell, Mr. Sorrentino. Thank you for joining the Travillian Next podcast today. It's good to have you both.
Oh, thank you, Mike. Appreciate it.
Same.
It,
Looking forward to it. So it's a little bit of a little bit of a KBW reunion here. So
it is. It is. There's life after, right? It's been a fascinating couple weeks. I have a lot I want to dive into with you guys. Um, if anyone's watched these with me before, I love to lay some good foundation before we move forward. And I think one of the interesting things I noticed over the summer um, was it did seem like the M&A logjam was starting to break. The deal structures were a bit unique, which to me always signals that the industry is trying to really figure out ways to combine and recapitalize and do things. I'd love to maybe just get a quick thought from both of you about how you think those last few months before the election from an M&A perspective were kind of playing out and why you think those deals were starting to come together even before we kind of got the shot of last week.
Frank, go ahead.
you know, I'm going to start off. Yeah. So Mike, I think it feels like the activity that we've seen year to date. I think most of it really started late last year, beginning this year. I think as a lot of companies went through budgeting. And look, it's been really hard to budget with how volatile interest rates have been. And I know we all talk about Fed funds, but the slope of the yield curve is the more important piece. And you've had a 5 and a 10-year treasury that's been bouncing all over the place. But I think earlier this year we heard from a number of companies, and we had a chance to look at a lot of internal forecasting. It doesn't look so good. Even if rates came down, there's still just a lot of profitability, overall challenges. You've got earnings well below historical averages, and quite candidly, you have a lot of companies that just can't really earn their cost of capital. And so I think that coupled with, and this has been a little bit of a longer term trend, but there are just less and less capable acquirers. And I think you've got a lot of boards that are very attuned to this. And so, those two factors kind of meeting head on, that's what's been driving a lot of the M&A. So, we're seeing a lot of situations where you've got more sellers than there are acquirers. And you've got sellers who, maybe didn't want to exit for another couple years saying, hey, I don't really like this landscape. I don't like our own profitability forecast, and I don't like sort of the longer term, Game of Thrones call it. And so I'm going to go pick my partner, now because they're available and they're not tied up in any other M&A deal. And so that's been a theme on a lot of the deals that you've seen, and I think we're going to see more of that. I mean, most of the deals you have to think that are being announced today and that have been announced were in the making 6 months ago. And it has certainly helped that stock prices are up because the values of these deals look pretty good. Most of these deals have been all stock deals, but we're going to continue to see that. And the other piece to this is from the acquirer side. We have seen a lot of capital come with M&A. You've also seen capital come alongside securities portfolio repositionings. A lot of the capable acquirers last year were looking and saying, okay, I've got to drive earnings growth. Most don't have the organic growth capability that they had a year or 2, 3 years ago because the economy definitely is slowing down. And so that has also led to the conversation of, okay, we can buy our way into some EPS growth through M&A, or do we raise some capital and really acquire our own company via a securities portfolio trade or other things like you've seen a lot of divestitures of business lines and branch sales. And so that was the other thing that kind of met. And so you've got companies that are thinking about how to play offense, and then you've got some thinking about defense.
Yeah. And Scott, maybe bringing you in, the the capital raise alongside the M&A deals was, I think, a pretty unique occurrence, right? And if you think back, basically since 2012, I think we've all kind of viewed the industry as well capitalized, right? And through maybe 2022, right, give or take, and then as rates shot up and the kind of the last 18 months played out, more focused on CRE concentrations, things of that nature. I think the capitalization of the industry didn't appear as strong. And do you think that was really kind of the big driver behind these kind of tag-along capital raises, or do you think there was any broader kind of view that you would kind of think drove some of these actions as well?
I think it was a little broader, Mike. I think one, the fair value marks are still tough, and so there's a hole that capital is needed to fill, and I think that in large part drives it. There's certain regulatory ratios that are important, and so coming out of a deal having stronger capital ratios than you had going into it, I think is real important. There's a form of, call it insurance perhaps, with the regulators. I think one of the most important aspects, though, if you step back, investors like to back really good management teams, and I think the deals that we've seen to date, you've got a lot of those characteristics where you've got some of the strongest management teams, starting with the Fulton deal, exciting FDIC deal this year. I mean, maybe away from the capital with a purpose, let's not forget to thank James Beckwith once again. He did open the capital markets up once again in 2024 the way he did in 2021. But around deals, whether it be the Fulton deal, the Atlantic Union deal, a really exciting deal for the industry, people want to put capital to work in those kind of deals. We had a few really exciting deals with the Renaissance and Mid-Penn deals, and I think the common theme in all of these are investors get to back really good management teams, create that, call it connective tissue around an exciting M&A deal where they get to buy stock at a discount. Discounts have been healthier this year than we've seen in past cycles, but just the access to capital is what's different about 2024. We've had depressed capital in the industry in terms of new issuance, and so I think there's a little bit of an excitement to support these kind of deals and give companies and regulators all the comfort that the market is behind these deals. So I think that drives a lot of it as well.
Yeah, and it seems like generally, would you guys agree? Like I think the litmus test is always right. Like if a deal is not liked, the stock's obviously going to do pretty poorly when it's announced. But you haven't really seen that. I mean, it seems like and especially when you have these pretty obvious markers like a capital raise getting completed, that the investors feel pretty good about the deal. Would you guys generally agree with that at this point?
100%. I think it goes a long way towards neutralizing the public market arbitrage opportunity, right? By putting real fundamental buyers in place on announcement. I think there's a strong impact on how the secondary markets behave. And to your point, the deals are working right now. And so, there's still the issues that we talk about, the announcement to close risk. But I think ultimately investors are really getting to support strong management teams that are doing, interesting deals to make their companies better financial service companies.
Yeah.
Yeah, Mike, I mean, I'd add, I think, and I don't remember really the first big deal. It was probably the Provident Lakeland deal. That had been announced. That was at the end of 2022. Obviously, a much different environment across the board. And I think there was a lot of sticker shock at that time because, I think they announced a deal that was 15 or 17% dilutive to tangible book, big earnings accretion, and it was really just rate market driven. And since that time, it feels like, particularly in the last year, investors have gotten a lot more comfortable with heavier or upfront tangible book value dilution. I think that there's a view, if you ask most institutional investors, I think they view that rate mark EPS accretion really as core earnings. This is a lot different than if you go back in time to the accretable yield from the 2008 days. That was lumpy. It was credit driven. That was really hard to model, and really companies didn't get credit for that in terms of like a PE multiple. The rate marks are way different. It's an accounting driven, and it's timing. It is coming in. And it just feels like investors are getting a lot more comfortable with that. And look, we're also starting to see, and I think we're going to see more of it, starting to see some deals that are beyond a 3-year earn back. I do think that investors are giving companies maybe some extra latitude on earn back for the right strategic deal. And, I would say by and large, the companies, particularly the ones that have announced M&A this year with equity capital, these are really good companies who have a track record of doing M&A and also have a track record in most cases of organic growth. And so I think the investors, while a lot of the deal math doesn't include sort of the impact of growing the combined franchise at a higher rate than you would otherwise, I think the investors are of the mind right now, hey, you've got a really sound M&A deal. You're a good grower. You've done this before. We're going to give you more leeway. And so that's why I think you're starting to see more deals with 3+ year earnbacks.
Yeah. I remember the Provident deal in many ways started to uncover kind of the trail that led us to where we did, right? I remember when it got announced, if you look at it through like the historical lens, right? It was two pretty plain vanilla, not huge risk-taking New Jersey-based commercial real estate lenders, pretty decent deposits, high loan-to-deposit ratios, because that's, what most banks in the metro New York area does. But I remember the question came up, like, do they need capital? Is this going to be a problem? And it really kind of started that conversation. And, to their
Yeah.
credit, they eventually found their way home, but it was
Yeah.
obviously a painful process. Frank, so sticking with you for a second, pretty wild 2 weeks, right? So you have Trump not only win the election, but pretty convincingly, frankly. You have the Senate also pretty convincingly flip red. The House, somehow, we still don't know, but looks like it could also flip red. You have a 25 basis point cut. Superficially, all these things would seem to be very, kind of pro bank M&A. But I would love to just hear, I know it's only been a week, but have things truly accelerated, or do you think it'll take more time, or how would you kind of judge your pipeline, your conversations based on the events of the last week and a half?
I, I like to think about that as probably like two different groups. So you've got group one, which is there are some more deals, and I think you're going to see a handful of them announced here Q4. I've only really got, up until mid-December, usually. You're usually not announcing a deal alongside a holiday season. But I do think we're going to see some M&A deals that are, in exclusivity in LOI stage today that are going to get, done. Those are already happening. Is it a ton? No, maybe across the industry, maybe there's another 10 to 15 deals. And having the equity markets bump, stock, bank stocks are up 10% kind of week over week. Maybe there's another move there that's going to help propel a lot of these things sort of in from the red zone into the goal line, over goal line. I think the bigger question, though, to really what you're asking is, what about everybody else? I think this is a perfect time for if you're not, let's say deep in an M&A deal, hit the pause button for a second. We're gonna have to see what happens with the regulatory appointments. I think the consensus view is that across all the regulatory agencies, there's some different timing, but there's going to be much more pro M&A, pro business, people put into place there. That is going to help just drive more M&A, and even going back to the days potentially of a buyer doing, two deals at the same time, or being able to do something once every 6 months, as opposed to right now. I think there's only one bank. Equity Bank out of Kansas has been able to string together and continue to string together multiple deals over 1 year, but they're the only one that I can think of. Almost everybody else is today one deal per year at the max, really maybe even once every 2 years. I think that will change. The other piece is, I think everyone's got to rethink which deals are important. So, over the past few years, you've tended to see much more in the way of complementary franchises partnering up, not a lot of branch overlap. And it's because having branch closures as part of applications has just added to time and
Yep.
complexity. And then the other thing, to what you said earlier, I mean, there's a lot of metro markets, probably the New York City metro market mostly, where the combined companies' commercial real estate concentration has been problematic. I mean, there's a lot of precedent out there. You can see there's not a lot of M&A deals where you have the combined concentration sort of above that 300% area, 300 to 350. And so, if the regulatory mood changes on branch closures and CRE concentration, you're going to see some different deals than you otherwise would have seen. And also probably going to see larger deals. Look, there's been no shortage of larger deals announced over the last year.
Yeah.
Uh, Although some are publicly running into challenges, that'll be also interesting to watch to see how this administration change impacts that. But I think you might even see a acceleration of that. It still is pretty pent up, and so yeah. Look, I guess short answer is it's a game changer in how do you think about M&A and I generally think that people will be thinking, bolder and different types of deals than they otherwise would have.
Yeah. Well, I love the Brad Elliott shout out. Definitely running his own set of rules down there in Wichita. But I think technology is a big factor too. The geographic borders just mean less and less every 12 months that pass, right? But I totally hear you. Like I think like the First Defiance United Community merger, right? Like basically like left and right side of Ohio coming together, like to make Premier, which obviously sold to Westbanco, which is also
Hmm.
complementary. So like you do
Hmm.
see that, you just follow the breadcrumbs and it's certainly there. Um, Scott, shifting to you, back to you for a second. You said something in your earlier response that I wanted to drill in on, which is when is this bank IPO capital raising kind of isolated market coming back? Obviously we've seen them with deals. Valley obviously had the big announcement last week, which was isolated, but there's still a ton of private banks. And frankly, in my role here, I speak to more of them now than I used to when I worked at KBW. And there's still a lot of juice in some of these private banks. They want to grow. They want to find people to help them grow. And as balance sheet financials, right? Eventually, they will need capital as those growth plans proceed. So, what's your state? Kind of post the same rundown I gave Frank,
Yeah.
the wave of red. Where's the IPO pipeline stand? Other capital raising activities, maybe even non-equity. Like, what's the update?
Yeah, so I'd say on the IPO side of things, I'll use a few analogies. I feel like we're at the boarding gate. They're letting passengers on the plane right now. You're definitely seeing more and more, or hearing more and more of our clients want to talk about this, and a lot of them have the same characteristics. They're of a relevant size, probably over the counter traded, have some form of a liquid profile, but not anything close to what a public market listing can do, have uses for the capital. And so I do expect some of those planes to pull away from the gate and start getting out in the runway. We will see a bank IPO market. One of the points Frank made, and this is where IPOs come into play, there are a shortage of capable buyers out there, right? And when you go into certain parts of the country, those problems are exacerbated in certain growth markets. There just aren't enough companies with public currencies that have a capability to pull off M&A. So I think IPOs allow for that. Some of the more acquisitive companies over the last decade have come public and kind of followed that game plan and ultimately sold themselves. So I do think that we're going to begin to see an emergence of IPOs in the bank space in 2025. I'd say with respect to the public companies and how they're thinking about capital, look, the move we've seen here has been pretty extraordinary in a short period of time, and you've got now companies that are trading at whether at near-term highs or multi-year highs. They've got real valuation right now, and so I think the best companies always figure out a way to be opportunistic.
Yeah.
When markets are open, you go get the capital, especially for companies where investors think deploying that capital will be something they'd be supportive of. And so I think we're going to see some preemptive raises. the pipelines are certainly building on both fronts, Mike, whether it be IPOs or companies that may want to be opportunistic. And then, our pipeline around capital and M&A will continue to evolve. We do that well. We do a lot of that, and I think that's a big part of how we go to market. But I think all of that is going to begin to really kind of pick up another gear in 2025. We are starting to see the emergence of a sub-debt reopening. I think what will be different here is the rate environment is still stubborn. So the cost of that debt is going to be materially higher than where many of the companies that are looking to refinance would look to find coupons today. And so in some cases, it may be more attractive to replace that capital with permanent capital, and I think that's where equity comes back into play. But look, the capital markets are open. We've seen that this year, and I think we're going to start seeing all forms of capital begin to normalize relative to where we've been.
Yeah.
Mike, can I add in just real quick? Because I didn't answer the second part of your question, and Scott just hit on it, and he just made me think about it. So I know we've got all this animal spirits are back in the market right now, and things are opening. I think the question is, okay, what's the counterpoint of that? What can stop M&A or stop capital raising? I think the yield curve shift has been really interesting, right? So you've had a 10-year Treasury and 5-year too, I think, that's now, I think it's higher than where it was at quarter end. And so that's going to hurt AOCI again. It's going to hurt any sort of interest rate, mark to market. But the yield curve has finally got some slope to it, which is very good for just sort of normal everyday spread lending. And so it's an interesting dynamic, but all else equal, that may hurt M&A, or it's going to make M&A, you're going to have to raise some more capital to absorb mark to market. And maybe a quarter ago you were thinking that was a lot less of a capital hit. So I think that, look, we'll see how that plays out. That, like I said earlier, the long end of the curve has been a little bit all over the place over the last year. And look, I mean, the other thing that's sort of interesting, I guess, with that is, are we going to, with higher expectations around macroeconomic growth, are we going to restoke a inflationary environment? It looks like all signs today look like inflation's coming down. It's been a long process, but all the stuff we're talking about, and if you watch CNBC, animal spirits, I would think, would drive macroeconomic growth, which probably puts a damper on the Fed cuts. And this is the other area too. I mean, not to go off on a whole tangent, but most, including our own firm, the consensus Fed funds curve has Fed funds going down to 3.5 or so. That is hard to see, particularly if economic growth is going to accelerate. And so it just creates another environment with a lot of uncertainty. And also, if we are in an environment with a better yield curve, you may see some companies elect not to do M&A because they don't feel like they need to sell or partner up, and there's enough profitability expansion on their own. And so, we'll see how it all plays out.
Yeah. Lot to unpack there. I think first of all, I think, not to get too philosophical, but to Scott's point, I think it's good to see the industry looking to raise capital to grow. I mean, I think, over the last 2 years, there's been so much discussion around credit and margin. I think we just kind of forget that the mid-cap banks, the community banks, they're at their best when they're driving a nice mid-single-digit organic growth profile, picking up customers, lending to communities, sprinkle M&A, right? Everything's healthy. I mean, that's a good environment. So I think, I'd love to see steps to get back to something resembling that. And I think raising capital and having investor confidence to go look for growth and not be afraid to do that is a really positive thing. I do sit there and wonder mathematically how you can lower rates, boost real estate activity and tame inflation all at the same time. It seems a little optimistic. So I do get, I'm not going to lie, Frank, I'm with you. I get a little worried. When the election happened and I was looking at all my bank stocks up like wazoo, I just couldn't help but think like this doesn't seem like it's good for inflation. And I think it takes months for that to really kind of come into the data. So,
Yeah.
it'd be an interesting December, January, February. But, having said that, I did want to have one quick follow-up for Scott, and then one last question for Frank before we wrap up here. What's your sense, Scott, on where investors are positioned today? Like you see a big move like we did on the election, the day after the election.
Yeah.
It screams underweight, right?
Yeah.
But you guys put out your research team put out an interesting report last night or this morning, kind of showing where relative valuations are, and they've come up quite a bit, right, closer to the average. I know there was a point early in Trump's last presidency when we exceeded that, but like, what's your sense of how much more there is to go to get to neutral from an investor positioning standpoint on the bank group?
Yeah, I think we have a little ways to run here. First of all, I think a lot of the move is really driven by the power of ETFs today, right? I mean, you had a lot of new inflows in, not only to financial ETFs, but to just the small caps last week post-election. And you can see how powerful that is. I think call it fundamental investor, two buckets, those that have been committed to the space and are always, equal or overweight the space because of their mandates. And then those that can look to other sectors to put dollars to work. I think it's that second bucket where we've begun to see more of an equal weighting towards financials as some of the commercial real estate issues have not played out the way many had feared. I think more and more investors are getting comfortable on the credit side. Typically, a generalist investor is going to wait until the smoke clears. But I think we're beginning to see enough strength in that market where not everybody should be painted with the same brush. Where we've seen generalists really come back into the capital markets, or I should say increase their exposure to the sectors through the capital markets. Any one of these deals that have come to market this year, I bet a common characteristic is one or two generalist investors using the capital markets efficiently to increase their weighting. And so I think we're going to start to see more and more of that as the capital markets open up. But I think right now we're getting close to an equal weighting. I don't think we're overweight the sector, and because of that, I still think the sector has a lot more room to run.
Yeah, and what'll be interesting to watch too is like, is there, generalists, in my opinion, used to flock to a small group of names, right, when they wanted to build exposure. A lot of them aren't even here anymore.
Right.
So like, where does that volume go, right? Does it kind of coagulate around few other up and comers that take the place? Does it get spread out amongst more banks? Do you see better liquidity? It should be interesting to watch.
Look, I think one thing that's still really important is liquidity, right? Liquidity has not yet, or the desire for liquidity has not really changed yet. I do think that's what's going to really be one of the bigger changes, is we're going to start to see investors move down the asset size, the market cap spectrum, because that's where, in the end, you want to find opportunities to buy stocks that are, relatively inexpensive compared to the rest of the market. And I think that's the value right now in small caps. And I think more and more investors are going to look to that because that's an opportunity.
Yeah.
Yeah, and Mike, maybe just to add on that, I think if you look at where the regionals trade, maybe more super regionals, but they're at 13 times 2025 earnings. And that's either in line or maybe a turn or two below kind of long-term averages. They've moved pretty nicely. But I think where you're seeing, if you think that banks should trade somewhere in the, maybe call it 12 to 15 times earnings, a lot of the small caps are still only trading at 10, 11, some are at 12, but really not on average. And then you've got some even that are at 7, 8, 9 times earnings. And so, kind of classic, you see the move up first in the larger, more liquid names. As those get more expensive, to Scott's point, people are going to look down cap, and there's some really good companies down there. And the other thing that or at least we are hearing, and I think this is going to change, but even some of the best organic growth banks are saying that loan growth is very hard right now. And I think part of that's also because you can't really grow your CRE book. Very, very few have been able to expand that. So,
And
and look, you've
funding is
also
still
got
funding, incremental funding is still very, very, very hard.
it's competitive, it's hard, and then you combine that with you seeing all this stuff about private credit. There was another article in the Journal today about the Apollo, what they're doing. I mean, they're growing hand over fist. Like that, years of this now has created a situation that has moved a lot of credit growth out of the banking environment. That may change now. That may change, and so I think there could be a ton of upside still left. Just to go back to your original question, I mean, I think during the last go round, the last Trump bump version one call, you had a lot of companies that ended up trading at 2 times book, 2.25 book value. And it was really supported because earnings got really, really good. You had a number of companies able to put up, ROAs from 100 basis points to even 150 basis points. And so part of that you can see in the current estimates, but, you get a little bit more economic growth. And that we could go back into a environment like that's got a lot of upside. Some banks probably have 30, 50, 60% upside. Some maybe a little bit less, but there's still room for this, overall market to move up.
Yeah, I think I generally agree. I mean, you just have such an elongated period of these things being battered down for a lot of things that were, I think, justified, but also didn't exactly play out as people thought. Some were worse. I think margin was probably worse. I think credit was probably a little better, at least from a charge-off standpoint. But analysts never get anything perfect, but I think there's certainly the environment could look better. And like I said, you still look at 25s, and there's not a lot of growth discussion in the industry yet.
No,
There really
nope.
isn't. So it's hard for me to think that that's really priced in any way. If the group can profitably start growing balance sheets again in a well-capitalized environment, like that's generally a pretty bullish thing.
Yep.
Um, we're just about at time here. I did want to maybe just throw out kind of a fun question at the end here. Things, as I just mentioned, rarely go as we all think they will. If your clients come to you today and ask you what you guys think might be a big surprise or two in 2025 that we're not expecting, what do you tell them?
Scott, you want to go first, or you want me to go?
Well, I think just practically, we just kind of hit on this, right? I mean, the funding environment's still pretty stubborn. Margin pressure with loans repricing is still real, right? And so one bigger surprise could be that profitability doesn't materialize the way I think the bulls think it could. And I think that's just just a function of the rate environment and how long it does take to be able to reprice the liabilities and be able to hold your loans in a declining rate environment. So I think that's probably the one area that maybe we'll see how it plays out. We don't have a crystal ball, but that's probably the
Yeah.
one area that I think could be surprising.
Yeah, I was going to say Fed funds goes up, ends next year higher than where it is today, and maybe even higher than where it peaked out. It's a real possibility. Um, and that all said, I I've continued to beat this drum. Buying core deposit franchises is the best thing you can do when you're looking at M&A. We just went through a full rate rise cycle, so you can really study somebody's deposit quality, both mix and cost, and this is still like let's not lose sight of that. At the end of the day, that is I think what probably drives the most franchise value. Quality balance sheet is going to drive multiple. And you've now got a number of banks that have really made a career off acquiring really, really good deposit franchises. And so, as you're thinking about M&A opportunities, don't lose sight of that and don't just chase revenue growth just because that's kind of going to be the new flavor of the day. I think at the end of the day, deposit franchise is the most important thing.
Yeah. No, I think it's a perfect way to end. And, the banking industry is very cyclical. And part of that reason is because you get in these mindsets, right? It's all deposits, and then you have all the deposits, so you go chase the assets, and then you go too far with the assets, and then you need more deposits, and
That's right.
and there's a ton out of your control. So buying good deposits, staying well capitalized, always good things, and certainly things you guys will probably be pretty busy doing over the next 12 months helping your bank clients with. So, Scott, Frank, thank you for joining the Travillian Next podcast today. Great conversation. It was good to catch up, and thanks again.
Mike, great to be with you. Appreciate it greatly. So thank you.
Mike, thank you very, very much. We'll talk soon.